You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host, Sam Ball. This week on The Investor Way, we have Brewin Dolphin, BT Group, Compass Group, Burberry, Airtel Africa, and our US company of the week is Disney. Sam, do you want to kick off with Brewin Dolphin?
So Brewin Dolphin have come out with their half-year results to 31 March 2021. And for anyone who doesn't know, Brewin Dolphin are their wealth manager. So they have announced total funds have increased by 10.5% to 52.6 billion, and that's up from 47.6 billion last year. Total discretionary funds were up 10.9% to 45.7 billion, up from 41.2 billion last year, which was supported by positive net flows and strong discretionary investment performance of 9.5%. And that compares to the MSCI PIMFA Private Investor Balanced Index performance of 8.7%, which is what they use as their benchmark. Total discretionary net flows of 600 million represented an annualized growth rate of 2.9%, with gross inflows of 1.6 billion, and that compared to 1.5 billion in the first half last year, which they said demonstrated the value of their trusted advice, high client satisfaction, and broad range of propositions. They've highlighted that the retention rate of their direct clients increased to 98% in the first half, up from 97% last year. I'm surprised that the retention rate was 97% in the first half of last year, given what was going on, actually. So that is quite impressive. Anyway,
very persuasive.
Well, yeah, I mean, I would have, because I was thinking when it said 98%, I was thinking, oh, well, I bet in a recession that retention rate goes down. But then obviously we had the events last March and the retention rate was still 97%. So maybe not. Anyway, total income increased by 13.7% to 199.9 million, and that was up from 175.8 million in the first half last year, which was driven by strong market performance and elevated levels of commissions. The discretionary commission income was 14% higher at 38.7 million, and financial planning income grew 16.5% to 19.1 million, driven by higher market levels and continued demand for their advice-focused services. Total income was up 13.7% to 199.9 million. Profit before tax and adjusted items was up 28.8% to 47 million. Statutory profit before tax was up 44.3% to 40.7 million. And earnings per share for the half was up 52.1% to 11.1p. There were a few interesting points in the slides. So they've split their total costs, which were 138.6 million. And of those, 110.5 million, which is about 80% of them, are fixed, and 28.1% of the costs are variable. So that's quite interesting in that essentially if they're able to, any new funds that they get, you'd hope that means that a lot of it's just going to go straight to profit past a certain point, because obviously the fixed costs are just staying the same. So having it that high is quite good when things are nice and rosy. It does work the other way as well when things are going quite badly. They've said that in their recent client survey, 97% of clients would recommend Brewin Dolphin to a friend, and that's up from 95% last year. They've highlighted the average age of the new Brewin portfolio service clients in the last 6 months is 44, and that compares to an average age overall for the Brewin portfolio service clients of 53, and an average age for the core and 1762 clients, which is one of the other wealth management services they've got, of 65. They've highlighted that total funds in Ireland were up 12% to 5.6 billion euros, with discretionary up 20% to 3.3 billion euros. So that's, what's the exchange rate these days? So yeah, so it's just under 10% of the revenue comes from Republic of Ireland. And they don't have any presence in Europe, it looks like. It's just UK and Ireland. They also gave, in the presentation, they actually showed the allocation of their assets in the Brewin Dolphin balance portfolios.
Oh, interesting. What was the breakdown?
So it's 3% cash, 15.5% bonds, 69% equities, and 12.5% alternatives, which includes 3% of gold. Yeah, so the equities, and bear in mind this is out of 69 because it's only 69%, but 23.5% UK, 25.7% North America, 6.1% developed Europe excluding UK, 4% Japan, 7.7% Asia, and 2% emerging markets.
What percentage did you say, US or North America?
25.7%,
25%.
which is quite high.
Yeah. Especially for a UK.
Yeah, I'm
wealth manager.
surprised Asia and emerging markets are so low. In total, they're under 10% in total.
Okay. Carry on anyway, Sam. Sorry.
Anyway, so all that's really left is the valuation. So they've got a market cap of £1.05 billion and dividend yield of 4.15% and a price to earnings ratio of 15.71. John, thoughts on these results and Brewin as a company?
They certainly sound like decent numbers. I mean, the things that I'd wonder about is the threat from passive investing and Vanguard. And there was some talk, I think, in the news about Vanguard having some sort of more customer facing rather than just online service, and whether that would impact wealth managers to more sort of active discretionary like Brewin Dolphin. And with the numbers that we've had over the last year and the recovery from the pandemic and the stock markets, is that going to be sustainable? Is there sort of a big cyclical element to a business like Brewin Dolphin, while the figures obviously look very positive at the moment and it doesn't look all that expensive? They would just be some of the questions I'd have in my mind about it. And also, Sam, comparing Brewin with some of the other wealth managers, how do you think it compares?
I mean, in terms of the Vanguard issue, I'd say based on those client retention numbers and the client satisfaction numbers, I'd say Brewin would probably say they're not too concerned about that based on how happy the clients are.
Yeah.
I think the flip side would then be, well, what happens as those clients get older and die? Because you need to then replace another generation. And I guess they then point to that, the stats I was giving about the average age of the new portfolio service clients in the last 6 months only being at 44. So if they can continue to keep that cycle going, I think they'd say, well, it's not a problem. One thing that's quite interesting about Brewin as well is they're a lot more of like an actual like investment and stock picking service. So a good proportion of their funds under management, it's actually other IFAs that then just outsource effectively the portfolio management to Brewin Dolphin. So the IFA, IFAs might effectively just be a salesman, and then they take the client's money and they just hand it over to Brewin Dolphin, and Brewin Dolphin then just take their cut. So as to whether or not you'd want your IFA doing that is another matter. But I mean,
I'm paying the privilege to do that as well.
Yeah, but that's quite an interesting part of the business, I thought. In terms of what was the other part? Was it how they compared to the other ones we've looked at?
Yeah, exactly.
Yeah. So when we last looked at Rathbones and Schroders, they were at similar PE ratios. They were about 12, 13. Rathbones now is at 13.38, so it's up a little bit. Brewin's at 15.71. I mean, it's not a huge amount of difference. I think when we looked at Quilter, that was up about 17, and we couldn't really work out why.
Yeah.
I think based on those numbers, I think a PE of 15.71 is very reasonable. And I think part of the thing was that when we looked at particularly Rathbones, I just thought it was too low, really. I couldn't really work out why it was only 12 or 13. I still think Brewin Dolphin at 15.71 is very reasonable. And I guess it is a slightly different business in that it's probably more of like a portfolio service, if that makes sense, rather than an overall wealth manager like a Rathbones or a Schroders. But I think the valuation is pretty reasonable. What about you?
I mean, no, it certainly doesn't seem expensive. If I were picking a stock like this, I'd wonder whether I'd prefer something like, it's not the same, I appreciate that, but something more like Hargreaves Lansdown. I'd wonder whether that would be just pip it for me over those previous few wealth managers that you mentioned.
See, I view Hargreaves Lansdown as a completely different beast, to be honest. But,
Okay.
But I mean, I would agree with you, given that Hargreaves is in my own portfolio and none of the wealth managers are. I do have Rathbone's in my girlfriend's portfolio though. So
Okay.
I wouldn't put Hargreaves in the same category. Well, Hargreaves is a competitor, but it's not the same type of business, is it?
No, it isn't. But I wonder whether maybe in the long term, whether it would be a bit more sustainable than, against sort of the move towards passive investing than
I take your point, yeah.
some of those other wealth managers that you mentioned. But yeah, I suppose I do quite like it from what I've seen. And the other two that we'd also looked at with Rathbone, well, actually the other three, Rathbone, Schroders and Quilter.
I didn't like Quilter. But that was more valuation.
That was more valuation, yeah. Okay, shall we move on?
Yep. Is it BT next?
Yeah, so BT. So I don't think, probably doesn't need much introduction. British Telecom. They've had a bit of a torrid time in the last few years. They had their full year results, which are out this week. And they announced that for the full year, underlying revenue fell 6% to 21.4 billion. And underlying cash profits, EBITDA, fell 6% to 7.4 billion, which were both in line with expectations. The group attributed revenue fall, unsurprisingly, to COVID. They also said they had the decline in the legacy products and asset sales. Reported profit before tax fell 23% to 1.8 billion. In terms of breakdown, the consumer division saw revenue fall 5% to 9.9 billion. It was partially attributed to the closure of retail stores and pubs, reducing BT Sport revenue and lower roaming charges. So of course, BT do have EE as part of the company. Cash profits in the consumer division were down 12% to 2.1 billion, reflecting lower revenue, bonus to frontline staff and continued investment. In the enterprise division, revenue was down 8% to 5.4 billion. That reflected a decline of legacy products, especially the fixed voice revenue, which fell 13%, COVID-19 and other asset sales. Cash profits in the enterprise division were down 12% at 1.7 billion. The group expects COVID-19 to continue to impact this division, especially in relation to the SME customers. In the global division, revenue fell 14% to 3.7 billion. Cash profits fell 6% to 596 million. And now for the most talked about division, Openreach, revenue rose 3% to 5.2 billion and cash profits by the same amount to 2.9 billion. And with that growth being attributed to increased fibre and Ethernet sales, partially offset by declines in the legacy copper products. Operating costs did rise due to pay inflation, frontline bonuses and higher service cost. And the CapEx was up 6% at 4.2 billion, with 2.3 billion in network investments. Normalized free cash flow fell 27% to 1.5 billion, reflecting the higher capital expenditure and lower cash profits. Net debt, excluding leases, was up by 300 million to 11.7 billion. And the pension deficit stands at just under 8 billion. And BT have agreed to plug the gap with 2 billion paid over 13 years, secured against the EE business, another 2.7 billion paid in installments between July 2020 and June 2023, and a further 600 million payments between July 2023 and June 2030, in addition to 200 million in annual payments to meet any increase in the deficit of more than 1 billion. So a lot. In the coming financial year, BT expects the underlying revenue to be flat and underlying cash profits to be between 7.5 billion and 7.7 billion. They're not declaring the final dividend for this financial year, but dividends are expected to return next year at 7.7p a share. Following these results, the BT shares fell 3.5%. Sam, what are your thoughts on these results from BT?
What's the valuation like?
So the valuation is currently, it's got price to earnings of 8.4. That compares with a 10-year average of 10.3. And its market cap is currently just over 16 billion pounds.
So the market cap is only 2 times the pension deficit.
Correct. You are right.
I mean, I just think it's obviously a PE of 8. It's pretty cheap, but I'd say it's with very good reason. I know they've what did it say? There's not going to be a dividend this year, but there's going to be one next year.
It's expected to return next year.
I do not understand how they can justify that dividend when the pension is in such a mess. And I think, when you talked about the breakdown of the payments, that's a good chunk of the profits. All you're doing as an investor is the profits of your company are going to pay off the pension. They're not being retained in the business, and they shouldn't be paid out as dividends, although some of them are. And the deficit of 7.98 billion, what was that? It was about 4 times cash profits. But obviously, if that's just the deficit, I've not bothered checking because to me it's uninvestable. But I've not bothered checking. Obviously, the deficit is just the difference between the assets in the pension and the liabilities, which is what they're going to have to pay out to people. So if the assets in the pension drop, that deficit will actually get bigger, even though they're paying it off. And when it's already that high, I don't know why anyone would want to invest in this.
Yeah, and I mean, the same. And I mean, it's reflected in the share price as well. Over the last 5 years, the shares are down nearly 65%.
All that business is at the moment is just a mechanism for getting money into the pension that they've over-promised on. So it's not really a business that belongs to the shareholders. It belongs to the pension, really.
No, that's right. And and we're not sure what's going to happen with BT Sport, but it's been losing money. It'll be very expensive if they're going to buy Premier League rights again. Yeah, I guess people speculate about the value of the Openreach part of the business and splitting BT up, but I mean, it's just, I would agree with you. I don't think it's investable. And also, I mean, from a utility company, you'd like a dividend, and I mean, you wouldn't like it to be probably paid for as they might try to pay for it. But no, I don't think there's really anything that would attract me to investing in BT at the moment.
Probably not the pick of the week then, is it?
Well, what else have we got? We haven't heard of Airtel Africa, so I'm excited for that. But what about our next company? We've got Compass Group. Do you want to tell us about that?
Actually, I didn't like that one either. I don't want to spoil it though.
Well, come on, out with the results.
Compass Group. So, if anyone doesn't know, they provide food and support services. Segments include North America, Europe, rest of the world, and central activities. The European segment includes Turkey and Russia, and the rest of the world segment includes Japan. The company offers its services to customers in workplaces, schools and colleges, hospitals, at leisure and in remote environments. It provides breakfast, lunches and dinners, and also offers hospitality services. And they also offer a range of support services, including cleaning, building operations and maintenance, business and office services, logistics and transport, outdoor project management and security. And they have come out with their half-year results, and they reported underlying revenues of 8.6 billion, which was a 30.4% decline from the previous year, which was in line with expectations. That reflected double-digit losses across most of the group's divisions, with defence, offshore and remote, and healthcare and senior living segments reporting minor organic sales increases. Operating margins for the first half were in line with expectations at 3.4%. Between January and March, the group's underlying operating margin was 4.2%, more than half of pre-COVID levels, despite lower trading volumes. Underlying revenue in North America, which makes up 60.4% of group revenue, declined 32.8% to 5.2 billion as a result of continued COVID-related volume declines. Compared to the fourth quarter, sales were up 6%. Focused on cost control meant margins rose to 4.7%. However, underlying operating profits fell 60.6% to 245 million. Volumes in Europe, which makes up 26.4% of group revenue, were unchanged for the second half of 2020, as lockdowns across the region weighed on trading. Underlying revenue declined 32.8% to 2.3 billion, while profits fell 83% to 32 million. New business growth surpassed 5%, driven by the UK and Turkey, and retention in the region improved slightly from 2020 levels to 93.5%. Trading in the rest of the world, which makes up 13.2% of revenue, was the most resilient. primarily because of the exposure to defence, offshore and remote, and healthcare and senior living segments. Revenue of 1.1 billion was roughly 82% of 2019 levels and down 9.4% from 2020. Double-digit new business growth in Australia and Chile was a key driver, but was offset by COVID-related volume declines elsewhere. Underlying operating profit was down 22.1% to 53 million. Underlying free cash flow rose 173 million to 359 million, reflecting a focus on cash management as well as reduced capital expenditure due to delayed client openings and postponed new business initiatives. Net debt fell to 2.6 billion from 3 billion in 2020 and now stands at 3 times cash profits compared to 2 times at the same time last year. In terms of the valuation, the business trades at a PE ratio of 33.5 compared to a 10-year average of 19.1 and has a prospective dividend yield over the next 12 months of 1.5%. John, thoughts on Compass Group?
I mean, it seems to me that it's quite expensive for something that was, a stock that would be has been badly hit by a pandemic. I don't know. I don't think. Yeah,
it is. In terms of the share price, it's still down about 25% from the pre-COVID high.
Yeah, I still think it's not particularly cheap, and I don't know. You said the margins. Do you say were about 4%?
Yes.
Yeah,
about that.
Yeah,
but I think they've been as high as 7% in the past.
Yeah, I suppose. Looking at the shares, they have actually performed quite well. I mean, I don't know enough about the business, but that'd be my initial thought. It's a little bit on the pricey side for what it is and where we are in the sort of recovery from COVID and that sort of cycle. But you've looked at it in more detail. What did you think or feel about it?
It's just not a business that interests me, to be honest. And I think, I wouldn't particularly want a caterer. And when the market cap's already 27.5 billion, and that's 25% off. I mean, how big of a business can it actually get? And the dividend yield, prospective yield wasn't that high. To me, it just didn't.
I mean, to be fair to that, I think they have been growing the dividend. I think back, 5 years ago, it was about 29p, 29.4.
Yeah, but it's still a low yield, isn't it? And when it
is. It's
not a company I'd be buying for growth unless I've massively underestimated the food catering industry. But as well, it's not really a business I feel like I understand that well, and it's just not for me really. But I do agree it does seem quite expensive. There's no really way of saying like how long it's going to take for things to recover to normal. How long, for example, are people still going to be getting caterers for events? If it's like buffet style, for example, you're not really going to want that with like, it's just not going to be something people want at the minute, is it? Like food that other people have touched. And then, if we have a couple of years, say, of like social distancing where, that would restrict the capacity of the events. And there's just all these little unknowns that for me would just put me off. Yeah,
and like you say, it's 20% off an all-time high as well.
Yeah, so yeah.
No,
I prefer it to BT though.
Yeah, that's right. So we've had Brewin. So we've got another British company, which is Burberry. So Burberry, I think most people would be familiar with. It's the British designer brand, and they had their full year results out, and the group saw revenue fall 10% to £2.3 billion at constant currency. Comparable store sales, including online, were down 9%. These declines reflected store closures, reduced tourism, and reduced discounting. Underlying operating profit fell 8% to 396 million. That was ahead of analysts' expectations. The Asia Pacific region, 94% retail, was the only area to post growth, with comparable store sales rising 18%, with strong trading in mainland China and South Korea. Like-for-like sales were up 53% in mainland China in the final quarter, and this helped offset declines in South Asia Pacific and Japan. Total revenue in Asia Pacific rose 16% to 1.2 billion. In Europe, the Middle East and Africa, 59% retail, revenue came in at 628 million and was down 35% on last year. Like-for-like sales were down 44%, but only down 26% in the final quarter. And this region was particularly badly impacted by travel restrictions and store closures. In terms of the Americas, 86% retail saw sales drop 9%, with revenues of £475 million, which were down 15%. Overall, retail sales fell 9% to 1.9 billion, while the wholesale business saw revenue fall 17% to 396 million. And the group was also warned that underlying operating margins in the new financial year would be adversely affected, reflecting a ramp up of spending following cutbacks because of the pandemic and increased investment. Underlying operating margins actually improved in 2020 from 16.4% to 16.9%, despite the reduction in revenue, partly due to sales of full price items rising 7% in the year, which is a welcome reaction to the new collections and pricing. On a more positive note, revenue rose 8% in the second half, and comparable store sales rose 32% in the final quarter, down to positive trends in mainland China, Korea, and the US. Burberry's free cash flow was up over fivefold at 349 million, reflecting lower lease payments, lower capital expenditure and tax payments, and a well-controlled inventory. Net debt, including leases, was 101 million, compared with 538 million at the same time last year. And for the next financial year, Burberry expects continued efforts to reduce markdowns, to reduce comparable store sales by mid-single digits, and CapEx will increase at least 65 million on this year to 180 to 190 million, reflecting increased investment in store refurbishments and digital infrastructure. Sam, Burberry, is it a company that you've held actually?
It was in my girlfriend's portfolio, but she sold it a few months ago to buy Rathbones.
Okay, well, I mean, I know
she did quite well on it. It was after we covered it last time.
Okay.
I bought it for her, and then it basically went up to where it was pre-pandemic, but she probably made like 20-25% on it in 3 months. So I just sold it and put it into Rathbones.
Okay. So, I mean, obviously that's not a bad return. On these results, the shares were down 8% on the day. What was your take on them? Is it, I mean, as someone who's sort of been close, I suppose, to Burberry as a company, is this what you expected? Do you think the market's overreacting a bit with it?
I thought they were very good results. I mean, we looked at it, I can't remember now off the top of my head, but we looked at it about 6 months ago, and I want to say it was down like, we were maybe looking at like 1 quarter in isolation, but revenues were down more like 30%, 40% rather than the 10% they've reported for the full year. I think for revenues to be down 10% for the full year, given the year that they've had, I think it's very, very good. I think the increase in the Asian segment is very, very good, or the Asia Pacific region, and that's something that you'd want to see continue, especially given that a lot of the revenue decreases in Europe, it was basically made up of like Asian tourists coming over and buying it. So if you can just go to Asia, just sell it to them that way, then that's obviously a good solution. But no, I thought it was a very, very good year to have revenue drop by that little, given that a lot of the stores have been shut all year and how bad it was looking partway through the year. I think it's very impressive. And it's reflected in the price as well, because I think 10-year average PE ratio is about 20, and now it's only 25. So it's not like, like you say, dropping 10%. It doesn't seem outrageous, and it's a strong brand. Like you say, the growth in Asia is very positive. I suppose if we continue to see the COVID rates falling and continued success with the vaccination program, more international travel returning, then the numbers from Europe could really improve as well. I like it. And I think, it could have been a really, really torrid year for Burberry, and it's not actually reflected in the numbers. It hasn't turned out to be anywhere near as catastrophic as it could have been. So I think that probably shows to some degree how strong the brand actually is. Yeah, no, I think really, given the year that they've had, I don't think you could have asked for better results from them. They couldn't really have done any better, I would have expected revenue to be down a lot more. And especially, like I say, like with us covering it halfway through the year, and revenue was down a lot more.
I'll have to check exactly when we did cover it, but I mean, so much has changed since the Pfizer results came out. I mean, it's almost everything has bounced back, but that's sort of, the paradigm shift in how you would see the future post COVID, really. So yeah, I think Burberry it's certainly going on my watch list.
1 sec, I'll just find out when we do cover it. It was November, mid-November.
So
in the last 6 months, it's up 30.5%. But I'd say, given how the business was looking 6 months ago when we looked at it, that's probably justified.
Yes. Yeah, no, absolutely. Okay. So next on the list, we've got a company prior to this week, I don't think I'd really ever come across, which is Airtel Africa.
Yeah. So Airtel Africa. So I'll just go explain what the business does first, because I had also never looked at it. It's not really the sort of business you normally see listed on the FTSE, actually. So Airtel Africa is a leading operator of affordable and innovative mobile services in 14 African countries: Nigeria, Kenya, Malawi, Rwanda, Tanzania, Uganda, and Zambia, Chad, Democratic Republic of Congo, Gabon, Madagascar, Niger, Republic of Congo B, and the Seychelles. And they are number 1 or number 2 mobile provider in 12 of the 14 markets. And overall, they're the second largest telecoms operator in Africa. So across all the countries, they have 116.4 million mobile subscribers, 39.6 million data subscribers, 20.1 million Airtel Money active users. And Airtel Money, do you remember when we covered Jamia a few months ago? Or maybe it was only like a month ago. Do you remember they had the Jamia Pay segment? Airtel Money is pretty similar to that, actually. So Airtel Money, they describe it. It's an increasingly important part of the group's service offering. The Airtel Money business line comprises a mobile commerce service that's accessible 24 hours a day, 7 days a week through the customer's mobile devices. Working in partnership with local financial institutions, this service enables Airtel Money customers to send and receive money and to make payments for utility bills, and in certain countries to pay for goods and services, to deposit and withdraw funds through a linked bank account, to make cardless withdrawals from partnered ATMs, and to access microloans, which are facilitated by the group and accessible through its mobile network in partnership with third-party loan providers. And they have had 11 consecutive quarters of double-digit revenue growth and EBITDA margin expansion. So in terms of the revenue, 54% of the revenue currently comes from voice, 30% from data, and just 10% from mobile money. Yeah, so in a nutshell, that's what they do. So they're listed on the FTSE 250. It's just not really the sort of business you normally see on there at all.
What's its market cap?
It is £3.02 billion.
Okay.
So they have come out with their full year results. All these figures are reported in dollars, by the way. So revenue grew by 14.2% to $3.908 billion, with Q4 21 reported revenue growth of 15.4%. Constant currency underlying revenue growth was 19.4%, with Q4 21 revenue growth of 21.7%. Growth was recorded across all regions. Nigeria was up 21.9%, East Africa up 23.5%, and Francophone Africa up 10%. And across key services, with revenues for voice up 11%, data up 31.2%, and mobile money up 35.5%. Operating profit increased 24.2% to $1.119 billion in reported currency and by 32.8% in constant currency. Free cash flow was $647 million, up from 42.8% on the prior year. Basic earnings per share was 9 cents, down 12.6%. However, that was largely due to prior year exceptional items and a one-off derivative gain in the prior year. Excluding these, basic restated earnings per share rose 44.5%. Customer base grew by 6.9% to 118.2 million, with increased penetration across mobile data, where the customer base was up 14.5%, and mobile money services, where the customer base was up 18.5%. The recent slowdown in customer base growth has been due to new SIM registration regulations in Nigeria. So on their 3.908 billion of revenue, they had free cash flow of 647 million, which was 16.7% of revenue. However, that was after quite a large interest expense, which we'll get into a bit later. The CEO, Raghunath Mandava, said, so he said quite a lot, but of interest was, in line with our strategy of unlocking value in our mobile money business, we will soon welcome 2 new minority investors, the Rise Fund and MasterCard, in agreed transactions which value this part of our business at $2.65 billion, as well as bringing $300 million to the group. We've also agreed to sell more of our tower portfolio, yielding yet more cash for the business. The COVID pandemic has eased during the course of the year. However, more recently, we have seen a surge in cases. So far, this has had no adverse impact on the business, although we will continue to monitor the situation closely. So in the slides, there were a few interesting points. So data usage per customer grew 44.2% to 2.6 gig. Mobile money transaction value grew 53.6% to $46 billion. Average revenue per user grew 7.7% to $2.8. In terms of the contribution to group revenue, 40% of the revenue comes from Nigeria, and they've actually just renegotiated the license, so it runs for another 10 years now. So that's pretty good. 36% of the revenue comes from the East African countries and 25% from Francophone Africa. They've highlighted the leverage ratio continued to improve despite license renewals in their 2 largest markets. So they actually only IPO'd a couple of years ago, but pre-IPO, their leverage was 9 times their underlying EBITDA. And that's since come down to 2 times. It's still, I'd say, pretty high. And they're paying an average interest rate of 4.9%, which is fairly chunky. So the impact of that on the figures is that of the operating profit of $1.119 billion, 423 million of it goes as paying interest, which leaves profit before tax of 697 million. However, the debt is coming down, certainly as a proportion of the business. And if the business continues to put up those kind of growth rates, I don't like the level of debt, but I'd say it's not actually the only reason I don't like it is because the amount of the profit that's going to pay in interest, but it's not too concerning. So in terms of the valuation, what do you reckon for this, John?
Well, I mean, I be expecting 30 plus in terms of its sort of forward earnings, but...
So you'd be very wrong. So the company has a dividend yield of 3.62% and it trades at a PE ratio of 12.39.
Say that again.
Dividend yield of 3.62% and a PE ratio of 12.39.
Okay, and what is the catch?
I couldn't find the catch. The catch seemed to me to be the debt. And possibly the fact that it's not like you say, it's not a company of either of us have heard of before. It might just be that people aren't really covering it. But
yeah.
I mean, like I say, I'm not, the proportion of the profits that are going to pay in interest isn't ideal, but when the business is growing at 20% a year, you can forgive that. And for that to be, like you say, you would expect a PE ratio of, 30 plus. And if you were in America, that'd probably be the price to sales ratio instead, which is what we saw when we looked at Jumia. So to get it at 12.39 and you're basically getting exposure to Africa. I mean, I didn't cover it as part of what I was talking about just because we talked about it fairly recently anyway in terms of Jumia, but in terms of the proportion of Africans that are underbanked or not banked at all, but have a mobile device, it is a huge potential market. So yeah, it just seems crazy. What are your thoughts?
Yeah. No, I would agree with you. And I suppose this is the attractive side to the business, the potential for huge growth, which seems surprising that it's not reflected so heavily in the price. What are the competitors around, the companies competing with Airtel?
I didn't look at that in too much detail just because it's in 14 different markets. So it's going to vary across the markets. I mean, it did say that in 12 of the 14 markets, they're number one or number two provider, and they're the second largest provider in Africa overall. In terms of the money service, I imagine, I mean, obviously we're aware of Jumia Pay.
Yeah.
I'd imagine there's a lot of businesses that would want a slice of that pie. However, it's probably a pretty big pie. And when you're looking at these other businesses where it's all based on the potential of the business and, you know, all these future earnings, and you're paying a multiple of sales, and you can make a bet on Airtel Africa for a multiple of earnings and a very low one at that, I'm leaning towards starting a position next week whilst I continue to look into it more.
Okay. Yeah, I would need to dig into a fair bit more, but so I'm surprised that neither of us have come across it.
It's only, in fairness, it only listed in 2019.
Okay.
But in terms of as well the financials since it's listed, so there's only a few years of comparatives. So it only goes back to the 18-19 year, but from 2019 to 2020, revenue increased by 11%, and then that's accelerated from 2020 to 2021 to 14%. And then obviously the bulk of that is still just coming from the actual telecoms or the mobile side of the business. It's not coming from the payments and the micro loans and that side. So yeah, I think it looks very attractive.
Well, that might be the discovery of the week.
I just can't believe it's on the FTSE. I don't know why they decided to list there. Because, you know, if
they think NASDAQ or something like that.
Yeah, it just seems like the sort of thing where if they'd gone to America, they probably could have got a lot more money at a much higher valuation, I'd have thought.
Yeah.
I mean, that there's just no way this would be a 12 times earnings in America.
No, that's right. Well, that might be a good thing for being, you know, UK, well, not just UK investors, but it being UK listed for investors. Okay, so moving on to the US company this week is Disney, and they had their half-year results out. They announced that revenue fell 13% to $15.6 billion in the second quarter. That was down on analysts' expectations of $15.9 billion. Unsurprisingly, the declines reflect continued disruption to the Disney park experiences and products division because of the pandemic. Group operating profit rose 2% to $2.5 billion. And obviously these figures are in dollars. And that was because of a stronger performance in the media and entertainment business. There's a $414 million charge with reduction in value of some assets and staff redundancies across the parks, retail stores, and one animation studio. And then in a bit more detail, if we break it down, the media and entertainment distribution revenues rose 1% to $12.4 billion, led by an increased direct consumer revenues with those up 59% to $4 billion. Operating profit in that division rose 75% to $2.9 billion as the direct-to-consumer losses narrowed. And within the direct-to-consumer business, Disney now have 159 million subscribers across their platforms, which include Disney+, ESPN+, and Hulu, with subscribers more than tripling from the same time last year. And the linear networks, including ABC, ESPN, and Star, saw revenue fall 4% to $6.7 billion. That's thought to be down to the domestic advertising revenue falling, and especially due to the Academy Awards. The parks and experiences and products saw sales fall 44% to $3.2 billion, and operating profit falling to a $406 million loss. And the decline reflects the 58% fall in the domestic parks and experiences to $1.6 billion, while international sales were down 45%. Disneyland Resort, Disneyland Paris, and the cruise business were closed for the entire quarter. Free cash flow was at $623 million compared with $1.9 billion at the end of March 2020. And net debt stood at $40.3 billion, down from $40.7 billion.
Disney said that they continue to incur additional costs relating to the pandemic to ensure government compliance and safety for employees, talent and guests. And this could cost around 1 billion in the current financial year. And on the release of these half-year results, the shares were down 3.9% in the after-hours trading. So, I mean, Disney, Sam, what do you think of these half-year results and more generally about the company?
I thought they were fine. I thought, obviously, free cash flow staying positive and net debt staying flat is really all you can ask for, given how badly some parts of the business have been affected. So I think for them to be able to tread water whilst the Disney Plus snowball just keeps rolling and rolling, I think is very, very good. I know the shares were down after the results came out. However, they still added about 9 million new subscribers in the quarter for Disney Plus. And it was the same as we saw with Netflix, where they basically said a lot of subscribers were pulled forward. But that 9 million is still an extremely impressive number. And if it continues to add 9 million subscribers a quarter, I've got no issues with that. And the fact that we saw it happen to Netflix as well shows it's not just poor execution, it's just something that's generally happened for the industry. I actually opened a position in Disney the night before these results came out, so just before the little drop. But I mean, there's nothing in here that's any concern. And I think if the business continues to tread water until things go back to normal, whilst adding 9 million new subscribers each quarter to Disney Plus, I'll be very happy with that. What about you?
Yeah, no, I mean, overall, I really like the business, and it's got such valuable IP, which I do enjoy watching, and the brands that they have. And I suppose obviously COVID's had a big impact on the parks business, but I'd be optimistic about that
And the
returning.
films as well.
Yeah, oh yeah, and of course, and the films as well. I mean, did we ever cover Cineworld?
We did cover Cineworld.
We did, didn't we? I mean, I think that was going in the pile along with BT.
Well,
but
have you seen that they've cut the amount of time now? I don't know if it was Disney or someone else, but they've cut the amount of time where, like, when someone goes from the cinema, the window before it goes on like their own platforms, to just 45 days or something.
Yeah.
So I saw someone tweeting about that, saying that, you know, it's just, even if you are a cinema and you get through this, it's not going back to normal now.
No. So yeah, and I think there will be an element of pent up demand for the parks, and potentially if they start with the cinemas reopening too. And I think the same would probably apply to their cable business as well, which obviously it's not a huge part of Disney, but I could see improvement there. And then like you've covered, with the Disney Plus, I mean, I think that's, in the long term, it could be something that'd be hugely profitable for Disney.
And they've also got, I saw someone else talking about it on Twitter, basically saying that, what I think a lot of people forget as well with this Disney Plus is basically, it's like, so like the Falcon and the Winter Soldier, basically, it's like two of Captain America's mates have got their own spin-off show. And that's not as expensive to produce as it would have been with Captain America.
Yeah.
But people will still watch it. And what they're able to do is they're able to take these almost like these second tier characters and give them their own shows and produce this very high quality content that's still within these universes that people love. But then if these shows take off, you've then got all the other stuff you can start doing if people like it, like with the parks and all that. So a good example would be Baby Yoda, where Disney didn't expect it to be as successful as it was. But it wouldn't be a surprise if when things reopen, you get a Baby Yoda ride at the parks. And there's all the merch from Baby Yoda. So there's anything that's successful in Disney Plus, as well as being relatively low cost to produce compared to the films, it then feeds into the other parts of the business. So it all just strengthens itself, like all the different parts strengthen each other.
Yeah. And I suppose something that is less attractive about Disney is it's still carrying quite a lot of debt after the acquisition of 21st Century Fox. I think it's now about, what did we say, 40 billion, 40 billion or just thereabouts.
On net debt.
No. And it was 71 billion to acquire Fox.
Yeah, once it's back, the fact that it's trading water, once it gets back to profitability, I don't think that debt will be at concerning levels. And I wouldn't anticipate another acquisition the size of the Fox deal anytime soon. There's not really that many media companies that they could acquire that are the size of Fox, to be honest. But it is a one-off thing, and I mean, I think that's going to come down. I think the only thing that would have been concerning is if you'd seen that debt going up during the past year or so, which it hasn't.
No, that's right. That's right. So no, overall, I think it's a very attractive business. I do own it, and I would not be averse to buying more.
No, and I've just opened a position as well, so I like it.
Of the companies, then, which one would be your pick for this week?
I'm probably, given that I bought one of these companies this week, I'll probably have to say Disney, but I will be taking another look at Airtel Africa, and I probably will be buying some of that next week, to be honest. What about you?
Disney, I think, would be my pick. Yeah.
Yeah. Right. Unless there's anything else that you want to add.
I think that's everything. Well, thank you again for joining us, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.